One of the questions I get is where should the market, how low will this market go? Where should the stock market be? Look at the Dow annual returns. We're going back 100 years. Average is 6.3%, 86 years, 6.11%. I have different windows of time here. And this is the Dow returns. We have the S&P returns in this column. I'm going back 100 years in the Dow. I have data back to 1960. And so you see the annual returns. We'll start with the S&P here. And one thing you can do, instead of looking at if this is a bear market, how low will the market go based on its most recent high, where should it have gone over the years without Fed stimulus? Where would it have gone had it grown at a normal rate that we had seen in the past? Over time. So if you take, for example, 1959 to 1980, 3.97%, 1959 to 2021, 7.3%. This included lots of Fed stimulus. 1984 to 2007, that was from a middle time period of the Reagan administration to right before the housing crisis. And so then you also go into 2021, 9.48%. S&P from 2008 this is the low. The market sold off in 2008 for the financial crisis. It made a low in 2009 and went up to in 2021 at its peak. Another peak, 13.65%. What about 2016 to 2021? There wasn't a sell-off in 2016, but 16.31. What about from the very end of 2019? These are the numbers. They're like from the end of 2019, the end of 2016, the end of 2008, the end of 1984. So 2 years, going back 2 years, 21%. Why is this accelerating? Why is this accelerating? What is the average growth? What should it be? And so if you look back, Fed funds rate has massively entered into the market. And it's increased the acceleration of returns in the stock market. If you look at the Fed funds rate historically, just flatline down here at 0. Emergency rates tried to come off, went back to emergency rates, trying to come off here. And so we had a huge bond bull market, extra low interest rates for the last 40 years, lots of Fed stimulus into the market. And so what would the normal rate of return be based on an index level, not including dividends, but just on price? And if you look at these numbers, the highest number in here is, the average number is 5.51 with the highest number of 7%. We'll go with the 7% number. 1931 is kind of the bottom time frame of the 1929 crash till 2007 before the market crashes again. So we'll go with 7%. That's a generous number. We'll use 7%. If you have 7% going forward from 1980, these are the numbers I came up with. 2175 in the S&P, 15445 in the Dow. And so that is one way to look at it. There's no way to know for sure what the true value. There's so many dynamics to this. But if the market had returned, if the Fed had not stimulated the economy, in the 80s they talked about the plunge protection team started under Ronald Reagan, and since that time frame, it seems to be from 1980 forward, there's an acceleration in returns, and there's more financial engineering. We're enlightened now, and we do this financial engineering stuff. But what are we really any more productive? Have we really created any more extra value through our financial engineering? And my belief is no, we haven't. Financial engineering, printing money does not increase value, and so 7% is a normal number to look at over the years. And so if you go 7% from 1980 forward, then you have these numbers here: 2175, 15445, which that's about half the current Dow value, and a little bit, not quite half. The S&P is currently at around 3,800, so quite a ways lower to real value if you take it as some values over the years from where it should be. So I wanted to share that analysis with you and the acceleration that we've had in the stock market, and where we might be had we just organically grown based on our own productivity over the years. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.